everyone, I'm Amy Northard, the accountant for creatives. Welcome back. Today we've got a hot topic on our hands, capital gains tax. We'll dive into how it applies to short-term and long-term gains, and most importantly, how it affects your overall tax strategy. So let's get started. First things first, what are capital gains? Well, capital gains are the profits you make from selling assets at a higher price than what you paid for them. These assets can be stocks, bonds, real estate, and other various investments. For example, imagine you bought a stock for $1,000 and later sold it for $1,500. The capital gains tax would be applied to your $500 in profit. Now, how much tax you'll pay on that $500 depends on several factors: your income, the length of time you held the asset, short-term versus long-term, the type of asset you sold. It's crucial to understand how these factors impact your capital gains tax to manage your investments effectively and maximize your portfolio's growth potential. All right, let's break down the difference between short-term and long-term capital gains. Short-term capital gains are like fireworks, quick, exciting, but they burn out quickly. The pros, you get instant gratification. Your money comes in faster. However, there are some cons. Short-term gains are often taxed at your regular income tax rate, which can be as high as 37%. Plus, short-term investments can be quite volatile, leading to potential losses. On the flip side, long-term capital gains are like fine wine. They get better with time. The biggest pro, lower tax rates. Most taxpayers will pay a 15% tax rate on their long-term capital gains. Additionally, long-term investments are typically more stable, offering steady growth potential. But there's a catch. You need patience, as your money might be tied up longer. And just like any investment, there's still a market risk involved. So, are long-term capital gains always better than short-term? Let's find out. Both types have their pros and cons. Your choice should align with your financial goals and situation. If you're after quick thrills and can handle higher taxes and risks, short-term gains might be your thing. But if you're focused on long-term wealth building and paying less in taxes, long-term gains might be the way to go. Of course, it's always a good idea to consult with a certified public accountant to get a comprehensive view of your financial plan and how capital gains tax applies to your specific investments. Now, here's a common question. Can you avoid paying capital gains tax? The short answer is no, you can't completely avoid it. However, there are legal ways to minimize your capital gains tax liability. One way is to hold on to your investments for over a year, benefiting from lower long-term rates. You can also use tax loss harvesting to offset gains with losses. And don't forget about tax-advantaged accounts like education and retirement savings accounts to potentially reduce your tax burden. So, how do you actually pay capital gains tax? Typically, you'll report your capital gains on your annual tax return. You'll use Form 8949 to track your gains and losses, then report those subtotals on your Form 1040, Schedule D. Keeping a close eye on your investments and their tax implications is vital. If you have any questions about capital gains tax and how to minimize it, consider consulting a tax professional for guidance. That wraps up our deep dive into capital gains tax. Remember, understanding these concepts is key to managing your investments wisely. If you found this video helpful, don't forget to like, subscribe, and share it with others. And as always, consult a tax expert for personalized advice. Thanks for watching, and we'll see you in the next video.